Well, hi everyone, and welcome to Buffett and Beyond Research Stock of the Week, and we're going over ULTA Beauty, and this stock is still beating the market. So let's get to the numbers and see why. And remember, folks, if you want to live on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And let's see what ULTA Beauty does, as if we didn't know. It's formerly ULTA Ceylon, and it operates specialty retail stores selling cosmetics, fragrance, hair care, skin care, and salon services. And I have that underlined because that's where a lot of the action takes place in the one store that I visited. Now, it offers more than 29,000 products from more than 600 established and emerging brands across a variety of categories and price points. Yeah, that's a lot of products, folks. Can you imagine keeping that inventory? Now, the company has approximately 1,445 stores in 50 states, and it's only added about 6 or 7 stores in the past 8 or 9 months or so. So it looks like the growth in stores has slowed down. Now, the largest concentration is in California with 174 locations and has about 20,000 full-time employees, which is about the same it had last year at this particular time. Now, the latest headline numbers came in above Wall Street's expectations, and that is why the stock is doing so well right now, and the company boosted its full-year outlook. Now, the better-than-expected performance was driven by a combination of new product launches, growth in both average ticket and transactions, which means people are spending more money. The average person going in there is spending more money than they did about a year ago, and benefits from leadership's new brand-building campaign dubbed ULTA Beauty Unleashed. Wow, how can you refuse that? Now, here's the question. Competition from online? You know, these products are not cheap, and if anybody can beat them, you can go online and look there, and we're going to look at the numbers in a second here. But let's look at the overall picture. And we're looking at the clean surplus ROE, and you want to look at this as though it's a bank. Would you rather put money in a bank that's earning 13.5%, which is the average stock, or ULTA Beauty, which has a 20.5% clean surplus return on equity? So, yeah, there's no question there. But when we get to net income, well, let's go to revenue first over here. The average stock has revenue growth of about 7.1%. Now, when I say average stock, we're talking about large cap stocks and some medium size cap stocks, but for the most part, we're talking about larger companies. So the S&P 500 plus another 200 or 300 more in our database, and we're looking at about an average of 7.1% revenue growth this year. And ULTA has a 12.3% revenue growth, so that's pretty good. But when we get to the bottom line, net income, and this is the bottom line right here, the average stock is bringing about 13% to the bottom line. In other words, almost twice as much as the revenue, so it brings the revenue down to the bottom line. But ULTA is not. ULTA is bringing less to the bottom line than the revenue it brings in. So there must be something there, like maybe the cost of their products are going up or whatever. Let's take a look. Okay, now right here, first thing we look at is the clean surplus return on equity, and we see the 5-year average ROE of 20.48%, but the 3-year average is 16.3%. So we can see that the ROE, return on equity, the clean surplus return on equity, was in the 20s for a couple of years in there, and that's when we had ULTA, right in here. But then that return on equity started to go down, and still go down. What does that mean? Well, let's look at the net income, which are the clean surplus earnings, and that has stayed the same. In other words, it's making a profit, but the profit rate is not increasing. So it's still making the same amount of profit. But look down here, you could see where the profit was going up. It was doing very, very nice, except 2020, and that was COVID. But it was steadily increasing with the exception of 2020, and then increasing in 22 and 2023. Wow. But it has stayed the same and expected to stay pretty much the same for this coming year. So even though we read before where it beat expectations and was doing very, very good, Yeah, but evidently the expectations were not that high, because here's the expectations right here from a different data source than the information that we read from. So we can see the clean surplus ROE declining, declining, declining. And to get into our growth portfolio, we want to see an average ROE of around 20%. And that's why we had this stock in our portfolio for a couple of years, and then it just started fading away. So we got out of this particular stock. Now, maybe we shouldn't have, but because when we look at the prices in a minute, you're going to see why. Retention rate 100%, which means all the money they're bringing in goes back into the company in order to grow. The problem is it's not growing. So that's one thing we have to worry about. And I'm surprised the market has not picked that up yet. But the market has picked up that this stock has no debt at all. And it also has no dividend, because it's taking all the money it makes, putting it back into itself, which is what we like in a growth company. And we like that it doesn't have any debt, but it's not bringing money to the bottom line. Is it because there's competition out there? Is it because things are getting more expensive and the company is eating it themselves rather than passing on the cost to their customers? Because don't forget, their customers know how to push the buttons on a computer and order these products online. So that's where ULTA has its competition from, online. So let's look at 1 year. Now the blue line is the S&P 500 and the black line is ULTA. So you can see that ULTA wasn't doing too good. Now this is a full year, so 12 months. Wasn't doing so good 6 months ago and 12 months ago. So in this area right in here, it wasn't doing so good at all. And then all of a sudden, because it beat expectations, it has jumped up nicely. So yeah, it's almost doubling the S&P 500 over 1 year. Over 5 years, same thing. So the blue line is the S&P 500. The black line, again, 5 years, here is ULTA. But remember that back here, they were making money, and here time has gone on and they're not making any more money than they made back in here. So it's hard for us to see that this stock is going to go to new highs unless it starts bringing in more of a profit. But still, the market doesn't lie. The market likes this stock, and it likes that it beat expectations recently, and you could see the big move up, and all of a sudden people are buying this stock once again. We're not in our portfolio. The ROE of 14, almost 15% is still higher than the average stock. So by using the ROE, we should see it outperform the S&P 500, but we don't see it gaining new highs going forward unless all of a sudden it starts making a better profit. So yes, let's go back. Because it does have an ROE higher than the average stock, and it shows up right here, we would expect it to outperform the S&P 500. But we have things like the net income, or the profit, is not as high as we would like to see it, because it has been higher in the past. So that's why we're staying away from the stock, even though it is a better than average stock. And looking at the 5-year return, yeah, it should be better than an average stock, but not good enough to get into our growth portfolio. But for those of you who like this company, yeah, it's better than investing in the S&P 500, because it's making more money than the average stock in the S&P 500. The problem is the profits are not increasing from here on in unless they change something. So folks, we had a good week in the market this past week, and everything's looking good with the Federal Reserve lowering interest rates. So take a few pennies off the table because you're making money in the market. Go spend it on you and your family. Enjoy it. Take your mind off the market. So most of all, be with your family, be with your loved ones, and most of all, stay safe, and we'll see you right back here in a couple of days.